let's kick off. So, quick intro from my side. My name is Ivo Pertz. I've now been an entrepreneur for over 20 years. I've worked and lived in 4 different countries with various financial systems and various tax setups. I've also lived through 2 financial crashes, a pandemic, and a war. So I've been through some crisis scenarios that I'll be sharing with you guys later. And I started early life ignoring finances and financial people, basically. So I just wanted to get things done, and I started to understand the power of finances only once I was forced to hire a CFO by one of our investors. And now I'm sharing practical financial knowledge. And recently, I've been helping SaaS, marketplace, and e-commerce type companies find new growth at the intersection between product, marketing, sales, and customer success. And I'm on a mission to make financial insights and knowledge be accessible and easy to understand, and most importantly, actionable, so you guys can take actions and improve your financial situation or the situation of your business. So the topics, just to remind everybody what we're going over today. First is accounting basics, so cash versus accrual accounting, cash flow gaps and their types, what to actually do and how to actually avoid cash flow gaps. Then we'll look into unit economics and how to price your services and products better, and what to do if you're in an actual cash crunch. And if we have some extra time, then we'll go into some Q&A. So let's dig in. Accounting basics. So before we we'll start off, I wanted to give you guys a little bit of history so everybody's aligned and everybody is on the same page when it comes to thinking about these things. So this is going to set us up in terms of how we think about finances. So if you think about it from a historical perspective, the early tradespeople and the early financial relationships that we had were very one-dimensional. And these are people that were producing something, selling something, and it was very, very one-dimensional, right? So the characteristics that you can say we had then was, if you have no money, you get no product. Wealth means accumulation of gold or physical goods or coins or something like that. So you actually have a pile of stuff that's piling up. These are very simple one-dimensional type of transactions, and it's a production-driven economy. So you have to produce something, a good. Mainly it was goods, and once you produce the goods, you're a manufacturer. Then you sell those goods, right? So very easy, very simple type of mathematics. Very intuitive for everybody. This is how we learn how finances work as kids, and everybody. And you don't need a degree to get this knowledge. But as we started becoming more advanced and we started having trade deals, and we started running into some difficulties. So it's difficult to run repeat business. It's close to impossible to value a business, and there's very poor asset valuation. And the books are really easily manipulated, right? If you keep a ledger of only the cash coming in and going out, you can see yourselves how it's easily manipulated. You don't pay a few people and it looks like you have no expenses, and then everything is basically looking much better than it actually is. So as we had a need for something, what did smart people come up with? They came up with accrual accounting. So what is accrual accounting? And the official definition is this: revenue is recognized when goods or services are delivered, and the earnings process is complete. Okay? Now, if you understand that that sentence, then the next part will make absolute sense. While expenses are recorded when they are incurred, regardless of whether payment has been made or received. Now, why did I say that if you understood the first part, the second part will feel easy and simple? Because an invoice is doing actually 2 jobs at the same time. Think about it this way. If you are issuing an invoice, that is your income, right? That is revenue that is for your business. But at the same time, it's an expense for somebody, right? So the first part, when it says revenue is recognized when goods or services are delivered and the earnings process is complete, that means I've done my job, I've issued you an invoice. Guess what? Somebody else, it has to come somewhere else. So it's an expense for somebody else. And that's all this basically means. But if you're a little bit like me, I'll put it even in simpler terms. So all entries into your reports, so into your books and logs, are based on the date when you issue an invoice or when an invoice was issued to you. Okay? So the main thing to remember here, it's a question about timing. and obligations. So you can also think about it from a perspective of, to estimate a company's value, what we want to look at is not only how much cash is moving hands, but what are the obligations and what are the, what is the company obliged to do? What is it signed up for to deliver, and and who owes what to them, right? So because of accrual accounting, they came up with there's 4 key terms that you need to know about that. And the first one is accounts receivable. So accounts receivable is it's money that customers still owe you. So this is basically the amount that you're still expecting to come in, and you don't need to do anything for that. You've already delivered everything, and so the transaction is finished. In terms of obligations, there is an obligation on the supplier to pay you. Okay, so that in your accounts receivable will come up as accounts payable on somebody else's balance sheet. That's the way it works. So you have the positive side and the negative side, and that's how all books are kept, right? So we have a ledger and we have a way of understanding the relationships between different companies. So the flip side, accounts payable, is exactly the opposite. So it's money that you owe to suppliers. So you still have to pay that. So the obligation is on you to pay that in the future. It's been registered. You're going to have to pay this. These are amounts that for sure are not going anywhere, right? Bar bankruptcy or people just not paying and this kind of stuff. The third one is accrued expenses. So this is an interesting one because these are costs that have been incurred but haven't yet been invoiced. So what this means is actually that you've already paid, but you haven't received an invoice. So the actual money has left your bank account, so you don't need to pay for that anymore, but you're waiting for an invoice to come in, okay? So the obligation is on the supplier to issue an invoice, not to receive the money. It's just purely to issue an invoice. And then the fourth one is deferred revenue. Deferred revenue is cash that you have received, but you still haven't earned. So you need to still deliver. You either need to deliver goods or you need to deliver a service, okay? So the obligation is on you to deliver something, okay? Now, because of these 4 concepts, the things that we can calculate in finances are 2 things. One is assets. So these are things that you own or control that has economic value. So you can either sell it, or it's actually, just money in the bank is also an asset because you can use it to pay for anything. Then the other thing that we can look at is liabilities. So liabilities are what your commitments to others and something that you need to pay and deliver in the future, right? So this way we can look at the hold on. You guys still here? Give me a heads up. All right, cool. So yeah, so with that, we can basically, have a uniform way of looking at any business and evaluating any business. You can also think of cash-based versus accrual-based accounting in the following way, right? So profit and loss is the normal report that you usually get from your accountant. You can also ask for a cash flow statement, and you can compare the two. So if you issue an invoice, there will be a change in the profit and loss, but there will be no change in the cash flow unless the money already came in. Once the client pays the invoice, there's no change in the profit and loss, but there is a change in the cash flow. So you start to understand these things. One is in terms of like the timing of the date of the payment. The other one is when is money actually moving in and then moving out. Okay, and this is the basis of most confusion out there regarding finances, and this is the reason why a lot of us get confused, because as business owners, as entrepreneurs, even as private individuals, we're mainly working in the cash flow type of world, right? Think about it. I mean, if you get a salary, that's all you're going by for the next month, right? Like it's, I mean, you can have other assets and all this kind of stuff, but it's like, I know I'm getting this much money in, everything else has been paid, and sort of so on and so forth, and I'm just paying off other things from that amount, right? If I don't have it, I don't have it. Whereas everybody else, the world, the governments, businesses, so on and so forth, are working on accrual. And the reason for that is so that everything is systematic and uniform. So let's go into two examples of what a profit and loss statement actually looks like. So this is an example of a standard, it's dummy data, of course, but this is what a normal profit and loss statement looks like. You can see that every month is very unified. You see that, everything is aligned, right? It almost looks like too good to be true. It looks like a table. It looks like a spreadsheet. It looks like a forecast or a plan. It doesn't look like it's a natural thing. If anybody knows this, like, you have big fluctuations month to month, and it doesn't show up here. But that is actually the reason why why they created it, so that we have this uniform way that we look at a business and we can understand, okay, this year it's been performing on average very, very good, or very, very badly. Now, let's look at the same business, but on a cash-based profit and loss statement. So this is something that would be more looking like real life. Okay. So as you can see here, the amounts are different. The total is different. The COGS are the same level. So if we go back, that was 240,000. It's 240,000 here. Similarly to cash OPEXs, it's the same amount as it was here. But you start running into fluctuations of cash because of the timing of payments. So let's say, taxes, these are some taxes that are paid on a quarterly basis. So like every quarter you get a hit. It's not like every month you're paying that, right? So that's why we see also that there's this fluctuation and normal seasonality. The other thing is, in January, if you're working with like post pay and stuff like that, you're probably going to have money coming in January from people that bought stuff from you in December or from November. Similarly, people that bought from you in December, that money is going to come in January of next year, right? So you have these kind of things. Also, if you look at standard profit and loss statements, they do not care if the money has come in. So that leaves a big hole in the budget, because if you have late payers or non-payers, that goes straight into your profit line. So let's look at the profit line here. It's for the year, we're saying it's 100,000, right? When we look at cash flow, so in this example, it's only $56,000. Now, please keep this in mind. You're going to be taxed the next year in this scenario off of this profit and loss statement, not off of what actually happened in your bank account. That's very important, because look at it here. If you report that you had 100,000 in profit last year, you're going to pay, let's say, 25% of profit on that. So you're going to get a $25,000 or 25,000 euro bill. And if you look at actually how much money that came in, it was half of that. So you made 56,000, of which half you're going to have to give on for taxes. So you're basically for the whole year, you got plus 25,000. Not a great business, not a great situation. But on paper, it looks much better, because your revenue is 600 and you're making 100. It's not great, but it's not bad. But if you're making 600 and you're making 55,000 in profit, and from that half of it is going to go for taxes. Yeah, it's not great, right? So this is the main source of confusion for a lot of people, and a lot of people don't think about these things when they're looking at it, especially from an operational perspective. Now, the other document that we get out of accrual accounting is balance sheets, right? So the purpose of a profit and loss that we just went over is, or income statements, they're also called income statements. So if anybody tells you income statement, just keep it in your mind. It's the same thing as profit and loss. So profit and loss, or an income statement, is a financial snapshot of what a company earned and spent over a specific period. Usually it's a quarter or a year. So I just showed you a monthly year and a year in monthly stats. And it includes all the income and expenses for that period. What a balance sheet does, a balance sheet is a snapshot, a specific snapshot. So like a specific day or a date and time, usually it's the 31st of December, of what the company owns, so its assets, and what it owes, so its liabilities and its commitments to other people at a specific point in time, plus the owner's equity that remains after liabilities are subtracted from assets. That's purely a mathematical thing. From an operational thing, you don't need to think about that. It's just purely so that the balance sheet needs to balance to zero. So obviously, there has to be a third kind of wheel to balance it out to zero, and we do that with equity. And equity can be a plus or a minus. But anyway, it's not for today. Just keep in mind that the main purpose of the balance sheet is to understand what are the assets and the liabilities of the company, or of the government, for that matter, right? So this is an example balance sheet. So you'll see as of 31st of December, okay, I put 2026, so we're just in 2026, didn't want to look old-fashioned. But usually they come out 31st of December every single year, and this is what they look like. So you have your assets, you have your liabilities, and then you have your equity. The equity will basically be whatever the difference is between these two. So you can see that in assets you have cash, so this is money in the bank, right? Then you have the accounts receivable, so this is pure profit. This is, you've done all your work, you've delivered everything. This is purely just you're waiting for money to come into your bank account. Then you have inventory, so these are goods in your inventory. Then you have also prepaid expenses, because you've paid up front, so you're expecting a service to be delivered, right? And here you have some other assets in terms of some property, equipment, and stuff like that. Then on the liabilities, you have accounts payable. You have accrued expenses. You have the taxes that are still payable. You have the current portion of the bank loan, or if you have a bank loan. And then you have the total, and then you have other longer term, maybe bank loans that are, if you have a bank loan for 5 years, you'll have two basically indicators here. One for the short term, so this year, and then you have long term, which is everything that you own for the upcoming years. And yeah, and then we have the equity, but let's skip that for now. So to look at it from a different perspective, you can see that what is profit and loss answer and what is a balance sheet answer. The profit and loss answer is, did we make any money? The balance sheet answers, what do we own as a company, and what do we owe to other people or other companies? What are our commitments in the future? Also, profit and loss is over a specific period, so it's usually annual, just set up by quarters or monthly. A balance sheet is at a specific date and time. And yeah, I mean, the core purpose, one is measuring the performance, the other one is showing the financial position. So, is there a lot of stuff behind this company? How have they used their capital, and what are their commitments to other people, right? Yeah, feel free to read over these, but just to circle back and finish the whole accrual accounting kind of purpose and specifics. This is the reason why we made accrual accounting, so that everybody can look at any company's finances or any government's finances or any organization's finances. So any institution is working according to accrual accounting, even nonprofits, even charities, all of this kind of stuff. Everybody is working with accrual accounting. So that's how everybody's looking at these things. And for most small, medium businesses and businesses that start out, cash flow is actually how you live your day-to-day lives, not accrual accounting. And that is the main message that I'm trying to put forward, which is you need to keep an eye out for everything that you do in your business, because your accountant is going to be living in the accrual accounting world, and they don't care about anything else. And they might be telling you things that they see in their reports because they make them according to their rules, that everything looks hunky and dory, but they don't dive into the details. So you might land up with cash crunches or other issues in the future. So 4 main issues of profit and loss for operators. The first one we kind of already went into. So it shows how much revenue you invoiced, and what others have invoiced you, but it doesn't show how much money has actually flown in. So keep in mind, you'll be paying taxes on what you report, not on what you actually get. So be very careful in terms of your terms and how you work with people, right? So you might land into situations where your accountant says you're doing well, yet your bank account is empty, or it's hard to calculate what you can afford or what your run rate is based off of the documents that your accountant gives you. You might have feast and famine months, right? Like we saw in the example that I showed you guys, that we had a month that you have 10K coming in, and another one where you have only 1. And it's good that it's still positive 1. It could be negative. So all of this results in anxiety, and you're shifting your focus away from business and towards plugging financial holes, which kind of hurts your growth in general. Issue number 2 is that the tax system doesn't care if you were paid or not. If you report that income, you will get the tax bill for that. So that leads to other confusion, and sometimes it feels like, hey, where did this tax bill come from? Why is it so big, right? It might feel like it came out of the blue. Sorry. And the other thing is you're paying taxes on the previous 12 months usually, if we're talking about profit tax or corporate tax. And if you didn't budget that in, or if you didn't keep part of your profit aside as for that payment, and your business is doing worse than it was doing last year, you might be in a problem, right? So just keep that in mind. And it's always good to keep some reserves, because just I always keep in my mind a truth, which is like, I don't own 100% of my profit. I only own like 75%, right? So whatever additional profit you have, set that aside. At the end, if you can switch some things around and it will be a smaller amount, that's great. But always keep some kind of buffer so you don't land in hot water. And then the third issue is that to make things even more fun, profit and loss statements usually have something called expense recognition. So the official definition of expense recognition is, and how it works is enough for a webinar on itself. However, for today, you just need to keep in mind one thing. If you pay any of your expenses on an annual or quarterly basis, so let's say you paid for a CRM system in January and you paid an annual bill, in the profit and loss statement for that year, so if you had that monthly view, it's going to be split up for each month. So let's say you paid 6,000 upfront for a year in January. What you're going to see in your profit and loss for that year is 500 euros across every single month. Why is that? The reason for that is so that it's you're getting the service every single month, and you've paid for it up front. So in the accrual accounting principle way, they need to take the proportion of whatever the service was of that payment. So the payment was 6,000, but it's 500 every single month. So it will confuse you even more, because that means that you have these months where if you're paying for some services upfront for a year, you have to be very careful and very smart about your cash flow situation, because you might just naturally run into issues where you have 1 month that's got a lot of payments, but it's like you're paying in advance for all the services for a year, right? So don't land into that cash crunch. Just keep that in mind, that's important. Then the fourth issue, that profit and loss is a great document from which you can make a balance sheet, which simplifies the whole process, of course, for everybody. You could also make a balance sheet based on cash-based profit and loss. However, you would need more documents, like a separate report on accounts receivable, separate vendor statements, purchase orders, contract schedules, and any notes on unbilled services or accrued obligations as well. So you would need just a ton more documentation. So it's a great way for you to have just very few documents to take a look at the health of a company. However, this means that the profit and loss statements are not the best way for business operators to look at their finances and make quick decisions. That's why I'm always looking at the profit and loss and cash flow statements and making decisions based off of that, and keeping an eye on how much my buffer is in my bank account. Okay. So yeah, just to cap it off with kind of accrual accounting, accounting tells you a story, or it tells a story. Cash flow decides if you survive long enough to finish that story. Okay, so keep that in mind. That's really the fundamentals and the differences between why people have a tough time living their life and not understanding why the financial documents don't add up to what you think they add up to. So next, we'll go into cash crunches. And basically, what are cash crunches? It's very simple. A cash crunch is when you need to pay for something and you have no money in the bank, or you have less money in the bank than you need to pay, right? And most of the time, this has got nothing to do with profitability. It's got everything to do with timing. As we saw before in accrual accounting, it's about the timing of the invoices and the timing of the payments. So you can think about it also from this perspective. You have like 3 general cash crunch meta categories. So the first one is overcommitments, and these are usually internal. So you've promised more cash out than your system could handle. So this is, you've overrun your expenses, or you've overextended on investments that you're expecting for growth, but they did, but they didn't manage to give that growth that you were expecting. Or these are, strategic or operational mistakes where you've overextended on some things or overpaid for other things. So this is basically where you're overstretched, but it's because of your decisions and because of your team and your management team and these kind of things. So it's everything that's you can control it, and these are scenarios where it's just been either wrong forecasting or it didn't deliver the way it was supposed to deliver. Okay, then the second one is inflow disruptions. So these are basically all your late payers, all your bad payers, or for some people, you can even think about it, all these customers that have agreed verbally to something, but then they don't deliver and they don't show up. Okay, so this is the inflow of money, and that's been disrupted in one kind of way or another type of way, right? Which means that you get the cash that you were expecting hasn't arrived, and the cash in is slowed or stopped, right? And these can also be external. Like, it's not always internal things. Like, there can be that a new competitor came on the market, or nowadays we have this AI boom and everybody's worried about their jobs and their businesses and these kind of things, because there's a risk that AI will quickly finish us all off. But it can also be like external shocks, like a general downturn, like if you're in a market that's very dependent on something, and something happens in the market, and those are the first kind of expenses that people cut, then your business is going to be touched, no matter how well you've done everything from your side, right? And then the third type and the third level of cash crunches you can think of is basically forecast errors and volatility. So these are when reality really deviated from the projections, and that's usually where most startups have a big issue and a lot of hiccups happen for startups, because their forecasting is based on wishful thinking, on like I think, or we expect. These type of words are usually used when they come up with a forecast. So it's not an actual budget, because there is nothing to really base it off, right? And usually startups base their forecasts on bets that they're willing to make, rather than looking at historically the past 12 months we've done this, so we expect this to grow by this much based on stuff that actually worked and generated revenue for us, right? So you can think about it from that perspective, but there are some other things to also kind of keep in mind here. So sometimes you have some failed launches. So maybe you're launching a new product line or something new, and you have high expectations for that. It doesn't work out. It never really works. It usually doesn't work out. And sometimes it overshoots what you were expecting. So win some, lose some. But in general, these are bets that people make. You can think about it that way as well. These are bets that people make that will help them grow the company, but they're uncertain if they'll actually work. Okay. And then, just having better planning is always key. Then you can think of here are 4 examples of things that you can implement that will help you manage your finances better and help you get out of stay away from cash crunches and not land in one to begin with. So the first one is actually creating a incoming payment calendar. So as you saw in the profit and loss, all your income is booked on the month that you made the invoice, right? But you have two strong points here. One is that the payment behavior of your existing clients, so you can map out their payments based on their payment behavior. And what I mean by that, I'm sure you'll have customers that you issue an invoice. They're the type of customer like me. As soon as I get an invoice, I pay it immediately as soon as I get it, because I just know I'll forget about it. Like, that's my thing. I just like to do it that way. I know it's not very super efficient, and sometimes it doesn't make sense. But for me, it's just the easiest way, and then I sleep sound at night. And then you're going to have people that are like, oh shit, I forgot. And it's like every single month they forget, right? And you have to chase them a little bit and stuff like that. So, and instead of paying within the time frame that they have, so instead of 30 days, they're paying always in like 45 days after the invoice has been issued and stuff like that. So if you can map out and you can create a calendar where you understand how much money is actually going to come in based on past behavior, then you can benchmark that against what your expenses are going to be set up, and you can see more or less where you're going to have a cash crunch. So that's the second point, which is create an expense calendar in terms of when you actually have amounts to pay, and then compare the two. And if you look at the calendar over the next 12 months, you should have basically 2 high numbers, right? Like, this is the expected income from a cash flow perspective. Excuse me. And this is the amount that's supposed to leave the account, but also based on cash flow. So remember the 12-month, annual fees and these kind of things, right? Like, make a calendar of when you're actually supposed to pay the amounts, not how much you'll be invoiced. And then you can understand, okay, you'll see the fluctuations. You'll see a month where it's like, okay, it looks like in this month we'll have a crunch month, or like we'll have a minus. like, do I have enough money saved in the bank for that, to cover that and cover that month? And I know which month it is, so it doesn't come as a surprise. And you can always also make some different actions if you don't have the money and already think about these things. Okay. The other thing that you can kind of look at before to not land in cash kind of crunches is try to work with as many customers as you can with prepay. So that's point number 2 here. So pull cash forward. Now, what that means is if you can get the money up front, and yes, you still have to deliver either a service or goods, but they pay up front. It's always easier for you to forecast your first of all, you only pay taxes on the stuff that actually comes in, because all your money is just coming in, right? So the tax question and the timing question is out of the window. So it just makes your life much, much, much easier. And that's why most people that have a business that's like a shop where, you buy, you get the goods, they don't really care about accrual accounting because their day-to-day hasn't changed. They don't have different types of payment terms, and their obligations are very simple, right? But for everybody else, if you have if you have a service company, or if you have a company that has fluctuating payments because it's something that's not standard, it's like either some delivery of commodities or whatever it may be, but like your invoices fluctuate from month to month. It's very hard to get a system that automatically gets money of different amounts every single month automatically from the person's account. Then obviously you have to play with post pay, but the thing that I would recommend in this scenario is create some incentives for people to pay you something up front. So if you are a service business and you're fully booked, for example, offer a new service on top where you're basically saying, hey, listen, you can skip the queue if you pay me up front a certain amount, or whatever it may be. But like, be creative in ways that you get money up front, because it's the easiest way for you to secure your revenue before any money goes out, right? And that's very, very easy then to build on that business. But I fully appreciate it that it's not always possible. But if you can, set up as many things as possible to get money up front. And then the outgoing payment calendar, we already went over, the incoming and outgoing. And the last one is scaling expense mapping. So this is really something that nobody really talks about, and nobody really thinks about, except for business owners. So let me share a quick story with you guys in terms of how we landed in some hot water. So a couple of years ago, I was working with a customer who was using HubSpot for their marketing efforts, but they were only keeping 400 people in their CRM system. And the full suite of everything, so the marketing, sales seats, and all this kind of stuff, HubSpot was charging us, I think, €1 per contact that we had on the platform. So that was 400 euros per month on customers that on average were spending at least 500 euros with us per year. So, we were happy to kind of finance 12 euros per each customer, because all our communications was going through that. We also saw which products they were buying, so we could upsell them or cross-sell them. So we were really, really happy with the whole setup. But then we had a new marketing director come in, and she had a great idea of like, hey, we have a bunch of emails from trade shows and from other offline kind of events and things that we've been doing before. And we had something like 14,000 or 15,000 contacts on that list. And she's like, let's warm them up using email. And she then went, and we're like, yeah, okay, great. And then what actually happened is that without asking anybody, she just she just brought that contact list into HubSpot, because HubSpot will gladly take your money, and they don't care. I mean, they do care. The more contacts you have, the more money they're making. And what happened was that the next month we got a bill of not 400, but 14, almost 14,500. So once the boss walked in on that, we were like, okay, nobody knew this, nobody talked about this, right? So you need to keep in mind how all your suppliers, especially nowadays that we're using a lot of SaaS tools, we're using a lot of usage-based tools, and you have to keep in mind that all your suppliers have a specific business model that will scale as you also scale, right? So you just have to keep that in check, that as you scale, the costs of your suppliers don't scale exponentially compared to your revenue. And I would suggest keeping a ledger of different types of systems that have where they have risks. Some of them are really easy. It's based on number of employees that you have, right? Others are more complex, like I said, with these contacts, right? So, and if you don't share that information, your people won't know. And that means that you might run into some really, really big bills that you won't be able to pay. So those are the 4 things that I use for us not to land in cash crunches: forecast into the future, try to get as much money up front as you can, and understand where you have risks from suppliers, that so they don't balloon out of control. Okay. Now, let's say you've already landed in a cash crunch. What should you do? From the income side, there's only really 3 things that you can do. You can ask some clients to pay you early. So call up any customers that are supposed to pay in 2 months or 3 months or whatever, and ask them to pay a little bit early, give them a small discount, get revenue in that way. Your best customers who have money will probably take you up on the offer, and there's nothing wrong with that. The second thing that you can do is you can ask your clients for referrals and generate additional income. Now, like we should be doing this all the time, but what I mean here more is like if you call them as you as the business owner and just have a heart-to-heart discussion and say, hey, listen, I'm running into some trouble. We ran into a cash crunch. Do you know anybody that would need our services? I'm willing to give a big discount right now. And if you give me this contact, I'll give you a discount of 20% for the next year, for example. And really motivate people to give other contacts. And, whenever you do this, it might be just somebody else that they saw the day before that they'll actually say, oh yeah, now I know this guy that might be interested, and it's for free. So customers usually don't want their suppliers also to die. So when you talk to them, they will help you in one way or another. Okay. And the last one is create a promo or a new product line. Now, this does consume time and extra effort and investment from your side, but sometimes it can work, right? So think about these 3 things that you can do on the income side to get more money coming in or get money quicker if you're in a cash crunch and you really quickly need to pay some invoice. On the opposite side, so on the expenses side, not a lot of people do this, and I would encourage you to do a lot more of this, which is renegotiate payment terms with your suppliers. So either get more time to settle the outstanding invoice that you can't pay. So split it into 2 payments instead of 1 payment, or 3 payments instead of 1 payment. Or if it's like the annual contracts that are renewing in the wrong season for you, talk to them in terms of like, hey, can I switch? Can I pay you in a different month, and can we switch the terms so that like I'm paying you in high season or something like that, right? Just talk to your suppliers. I'm sure they'll be also happy to discuss something, because guess what? They don't want to lose you as they would be losing revenue, right? So people are usually quite open to discussion regarding these things. Second thing you can do is ask for a line of credit or payment restructure from your supplier. So this is not splitting up the payment. This is actually like a full restructuring. So let's say, if with this HubSpot situation that we had, we went from 500 to 15,000. Now we went back to 400 the next month. So, we ask, hey, listen, we made a mistake, honest mistake. Could you give us some credit for that? Or can you split that up so that we pay that 14,000 across the next 12 months or 24 months, or give me some kind of structure or something like that. Okay. And the third one is revisit all of your expenses and remove the non-essential expenses and change to cheaper providers. But I have a specific suggestion for you guys at the end of this presentation, so I'll run through that very shortly. Next part is unit economics. So unit economics, what that mainly means for me is that most people are good at assuming top line costs and scale their forecasts based off of that. So I'm living in Belgium right now. Let's go buy a box of chocolates, right? So let's say my new product is a box of chocolates worth 10 euros. What most people will do is they'll look at the visible costs. So you have the ingredients, so the actual components that create everything. That's, let's say, 25% of the cost. So that's €2.50 for me. Then we have direct labor. So these are the people in the factory that actually make the chocolate. That's another 15%. So that's another €1.50. And then we have packaging, which is another 50 cents, right? Excuse me. So most people stop here. They've calculated their operating profit, which is great and important because that's the first step. And in this example, it's your profit or your operating profit is €5.50 or 55%. However, that's what most people don't think about or calculate rarely are overhead costs, and that's where actually a lot of things open up when you look at it from a unit economics perspective. So what are the hidden costs for on top of that? So something that literally almost nobody ever thinks about is payment processing fees. So when you set up a business, you're going to have to take card payments. And usually that means you have some kind of processing, some kind of payment processing, and payment processing costs on average 2 to 3%, usually 2.5%. But for this case scenario, I use 2%, right? So straight off the bat, 2% is whacked off for just for you getting that revenue in, getting that money in, just for you to have the possibility to take the money. Then you'll have some rent allocation, you'll have some utilities, you'll have some marketing, you'll have some admin and accounting, which is, it's not done in-house, it's done externally. Then you'll have some inventory loss and waste, like some chocolates will get old and stale and you won't be able to sell them. And then you have insurance because you need to insure everything, right? So the total hidden costs in this case amount to €2.50 on top of the €4.50. Therefore, actually, the net profit is €3 per box rather than the 5.50. And remember, in my example, this is me doing or the person doing all the selling. The owner is doing all the selling. That means there are no employees, which cost a lot. And the other thing that nobody thinks about is you will owe tax depending on how much profit you made. So even if you make the €3 per box, 20% of that €3 is also, or 25% of that, sorry, is going away for taxes. So you're left with basically 2, right? Is 2 enough per box to cover also employees so that you can actually grow the business and you're not self-employed? I doubt it. So when you structure things this way and you actually look at like what are all the costs associated with any service or any good that you have, keep that in mind. So here's an additional bonus for you guys to use at your own will. So the first one, so it's called the growth mode framework. And basically what the growth mode concept is it's simply dividing your expenses into three layers. You have growth, sustainability, or survival modes. And by putting expenses and roles, so specific people's positions, in one of the 3 layers, you can clearly understand what is contributing to the business, what is an investment, and keep in mind that investment is always profit that has been spent on initiatives that you hope will. As you should have heard by now, hope is not a strategy. So the 3 layers of business. The way I explain it is you have the essential. So these are the things that keep your basic business operating. Okay. Think of it. This is what I needed when I started out and got our first pool of customers. This is your safe zone. This is like business can survive if we switch everything else off. So if you have no goods, if it's just an office and you're doing service type of businesses, this is your laptop, internet connection, these kind of things, right? And the second layer that you have is roles. So this is everything: tools, platforms, people, anything that you've implemented into your business that increases the productivity per person, so you can serve more customers per headcount, right? So as we evolve naturally as a company, the first question is, do I have any business here? Can I generate some customers? Once you start doing that, it's like, okay, now let's optimize that so I can serve more customers for as few people and as little cost as possible, right? And once you start doing that, those are the supporting tools that are there to help you support more customers with fewer people or fewer iteration points. And then you have the third layer, which is investment. So I treat investment as everything that has yet to prove that it contributes positively to the business. So if it's supportive, it has proven that it helps the business optimize on one of the processes. If it's an investment, it means you're hoping that it will drive more business for you. Either it's a marketing, all of marketing you can say is investment, and or it could be a new tool, or it could be a new person, or it could be a new team that's looking at a new market and entering into new markets. Doesn't matter. It's stuff that hasn't yet proven that it can contribute positively to the business. Like a team that's doing worse than your standard benchmark, that's an investment. So once you've done that, you basically have 3 modes. The first mode is the emergency mode. So this is the shit hits the fan mode. It's a shock situation. Think pandemic. We just went through one not long ago. Revenue drops dramatically, and it's unclear when what the future holds. So you immediately have a plan to implement emergency measures to cut all costs that don't bring you in money, right? So you have that because you can go back to the essential expenses, and that's it. Then you have what I call chill mode. So this is basically the mode where the business is running organically. Not much is being done in terms of investments. Everything is smooth. Financial buffers are growing. This should be the mode where you're either at the end game or where you want to save some money and grow buffers to invest for something else, right? And then you have growth mode. So growth mode is this is what you should be doing and using when you feel confident that the market is not going to crash. You have enough buffers and you see where you can grow, and that the investments that some of the marketing has proven itself, so you're willing to reinvest because now it's a supportive role. It's not an investment role anymore. All of these kind of things. So it's the mode where you're like, now I'm really driving, I'm really growing the business, and it's the growth stage of your business. Okay, so with this, if you've done it this way, you have these 3 modes to choose from, and please use that wisely. Additional bonus number 2 from me is hustlers, what I like to call the hustler versus buffer mindset. So I'm not going to go through all these points, but I'll just kind of explain what I think are hustlers and buffers. Sorry. So hustlers are you've probably come across these type of people. These are the contractors or the people that you've done some kind of job for them. You're like, hey, I've finished my work. Here's my invoice, and they're like, okay, great. I don't have the money, but don't worry, I'll find it. Right, I'll figure it out. So these are people that are always thinking of like, they're always moving their money around, and they're very sometimes efficient also at doing that. So they're good at plugging holes and good at finding other places where they need to. If they have idle cash, they see it as a wasted opportunity. Cash should be out there, invested all the time, which generates more noise, so on and so forth, right? So the stress level is very high for these people, but they've normalized that, and it's normal for them. And usually most kind of tradesmen or like smaller type of businesses, this is the way they work. They're working on cash flow, right? And they're closer to their cash flow, and they know kind of like, yeah, I'm expecting a payment in from them. I'm expecting a payment in from them. So I'm kind of like, I'm okay for this month, but like next month we need to still figure it out, right? And it's always like, next month, I don't know what the future will bring. Next month we'll figure it out. And it's all very short term, short cycle type of thinking. And then you have what I like to call the buffsters. So these are the very pragmatic people. You can think of maybe a typical German CEO or owner of a company that's, like, no, we don't like to take any risks. And these are the type of people that like have calculated their unit economics. And for every single sale that they make, they, set aside the amounts that were reserved for taxes and for everything else. And like you're you're planning ahead in years, not in months or weeks. And that means that you're setting everything aside so that you have these buffers and you can really focus on the business, and you don't need to think about the finances and all of these kind of things. So you're growing your profit, and you're growing your wealth, and you're accumulating more and more assets as you go along. And you really hate and don't like to be in a situation of uncertainty, right? In my experience, you're either more slanted to one or more slanted to the other. There's no really middleman in terms of how they deal with finances. It's either one or the other. Now, it's not that one or the other is better or worse, but kind of my top 3 tips is, use the hustler mindset when you're starting out. You are so far away from the market ceiling that you shouldn't really be worried about anything but growth. Okay, so grow, figure it out, invest, experiment, enjoy the ride. This is and so for buffsters, it's really, really hard to start new businesses because they don't enjoy this part of the ride. They don't feel comfortable in it. And but once you hit traction and you have something to save, you have something, and you have something that you can start thinking more longer term, start saving up, creating some buffers, and start, thinking longer term from that point onwards. And if you've already reached your market ceiling, you're probably definitely not watching this. So well done to you. You know what you're doing better than me. That is it for today. Thank you very much for attending. I hope you guys enjoyed this and got a lot of insights from this. If any of this is still confusing for you, or you want to go over these concepts with your specific financial reports, please feel free to reach out. We have workshops or we have one-on-one solutions for you, and I'm always happy to talk. Jump on a quick 15-minute introduction call, introduce myself personally, get to know your business, and see if we can help you out. So that is that. Thanks, everybody, and I'll see you in the next one.